Last week, we promised to deliver a very simple but highly efficient strategy for managing your allocation between stocks and bonds to maximize your long-term returns while protecting your liquidity during the intermittent but temporary declines in stock prices. So here goes. To set the stage, we have already established that at retirement, we will wish to set aside any significant capital sums which must be spent within the next 5 years. That should be invested in cash or very high quality bonds with maturities that are matched to the timing of those capital needs. The whole point is that this money just has to be there when we need it. So, our standard withdrawal strategy is as follows. First, we create 3 buckets of money, and we name them the short-term money bucket, the medium-term money bucket, and the long-term money bucket. Second, we put enough money in cash in the short-term bucket to cover any emergency expenses that might come up, like the roof on our house blows off or our car needs a new transmission. Whatever it is, this is our emergency bucket. Number 3, we put enough money in the medium-term bucket to cover those expenses we think we might need to withdraw from our investments in the next 5 years. Either for living expenses if we're retired, our daughter's wedding, a big trip, buying a shore house, whatever it is, we put the money for it in here and we invest that money in very safe bonds that are set to come due when we need the money. Fourth, we invest everything else in the long-term bucket. In a well-diversified equity portfolio, which we know we can allow at least 5 or more years to blossom. At the end of the year, we refill our medium-term bucket. If we spent some money that year from the medium bucket, we now look forward another 5 years and figure out how much we need to refill from our long-term bucket into our medium-term bucket in order to keep it funded with at least 5 years worth of expenses. In other words, we harvest the gains from our long-term bucket to accomplish this. And then finally, the only exception to this strategy is if we have a year in which the long-term bucket either stays flat or goes down. If that happens, we don't touch it, we just let it sit there and we give it some time to recover. We only harvest when there's been a gain to harvest. Note that this last part will also require the emotional fortitude to live with another year in which our medium-term bucket is a little short. But don't worry, we'll refill it again next year after the equity market has recovered. Sometimes the most effective things in life are the simplest. This is a very simple way to manage your portfolio allocations to make them the most efficient and effective possible.